Wouldn't it be interesting if we can apply those same principles that we were using when we were trying to help American Airlines select pilots, or we were trying to help Subway restaurants select managers and things like that? And wouldn't it be interesting if we can apply that same kind of thinking, but we do it for founders?
This is the Angel Next Door podcast, where we will talk about all things angel investing, what it is, who does it, how do we find them, what does it mean to invest in an early stage company. If you have ever wondered how you can affect the change you want to see in the world, then tune in to learn more. In this episode, I'm talking to Woodie Neiss of Crowdfund Capital Advisors, a crowdfunding advisory, implementation, and education firm. We discuss how he spearheaded a transformation in securities laws to usher in the era of investment crowdfunding. The episode is packed with enlightening details about how crowdfunding has evolved, the industries excelling in the space, and the groundbreaking ways entrepreneurs leverage their crowd for funding and expertise. You will also get insights into Woodie's comprehensive annual report and his latest book, Investimers, which offers a deep dive into the future of investment crowdfunding. Enjoy the show. Woodie, welcome to the Angel Next Door podcast. I'm happy you're here.
It is great to be here. Great to see you again. It's always a joy to speak with you about this fascinating topics that we both cover.
Yes, fascinating topics indeed. Angel investing and crowdfunding, one of the ways that just about anybody can be an investor in a for-profit startup company. So Woodie, tell us a little bit about your background and how you got to where you are.
Started on Wall Street, went to Silicon Valley. From there, started my own healthcare technology company that was venture-backed funded. Grew that from one pharmacy to 40,000. We flavored medicines for children so they're more compliant. After I sold that, I always sat down with a couple friends of mine and said the way in which we raise capital is broken. It's outdated. Kiva is allowing people to raise money online. Let's change the securities laws so that we can allow startups and small businesses to raise from their customers, their friends, their family, their followers. So luckily I was living in DC. I'd testified in front of Congress once before. So I went to the people that put me in front of the committees and I said, listen, we have this idea to update the securities laws to the internet age. We're calling it securities-based crowdfunding. It's now investment crowdfunding or regulation crowdfunding. Did all the lobbying in the House and the Senate, was invited to the White House by President Obama for the bill signing, and it launched this industry that's over 8,000 startups. Many of them are pre-IPO, have used this, and they've raised over $2.8 billion. So we're not even a decade in. It's been pretty cool.
That is amazing. Yeah. So tell us a little bit, some of the statistics, like who's fundraising, how much, how they get started, how's it grown, all the things.
Yes. So it's been an interesting past couple of years. It started with only $19 million in 2016, and it hit a peak of $557 million in 2021. But that's when we had the pandemic. And so we had a lot of money coming in that was supporting small businesses. And then we had the interest rates go up, the supply chain issues. We had geopolitical crisis going on. And so investors in the stock market were like, what's happening? And so we saw a pullback take place in 2022 that reversed itself in 2023 and 2024. But what was interesting in the data set itself is in the first several years of the industry, when it launched, it was mainly retail investors. So the people that are your customers in these businesses, your followers turning into investors and investing in these businesses. Then what we saw in probably like 2021 is a lot of these parallel offerings. So when you do a Reg CF offering, you can raise money from just retail investors and accredited investors through investment crowdfunding platforms. But you can do these parallel offerings. That's a Reg CF offering and a 506C offering where you're raising money from accredited investors in that 506C bucket. What we saw is since 2021 is there's been a drop off on the retail side because I think the retail investors are weary about these geopolitical and macroeconomic things that are going on. But at the same time, on the 506C side, typically accredited investors put money into venture funds. They work as angels on their own. They put money into hedge funds if they have that opportunity. But VCs were not really deploying capital over the past few years. They've been sitting on the sidelines. And we've been seeing more accredited investors looking for a deal opportunity. And they've been coming into this investment crowdfunding space. And they've been picking up the slack that we've seen really in the drop off in the retail side with more accredited investors coming in. So 2024 was almost a banner year for the industry with $543 million invested. And it's one of these things too, where when you're talking about the number of issuers that are coming in, it peaked in 2022 with 1,533 offerings. I think issuers as well are thinking, is this the right time for me to be raising capital? And so they've also held off. And so we only saw 1,350 issuers come into the marketplace and raise capital in 2024. The one thing I want to point out about this before I toss it back to you is if you remember, like there was a period in the late 2000s where it was the lean company, the lean startup. That was the thing.
Right.
Like, it was about, you got to learn how to run these businesses lean. You got to take capital that you get and manage that capital and not be excessive with your thinking. And I think we've moved back into that lean startup mentality, because if you can't rely on venture capital, if angels are being more selective as to where they're putting their money, and there is money out there, it forces you as an entrepreneur to think, how do I want to use the capital that I have and be smart with that investment?
Okay, so you said a couple of things. I just want to make sure our listeners understand. So you're saying that you can have a Reg CF or a crowdfunding offering going on at the same time that you have another offering, but it has to be a 506C. Now, I know what that is, but explain for our listeners, because it does get a little complicated as to what that means.
Yeah, the securities laws are complicated, and you have to understand the different ways in which you can raise capital. So typically, before even investment crowdfunding was there, I think the avenue that most people use, and that's what we used at FlavorX when I raised money from VCs, was a 506B offering. And that is where you can raise as much money as you want from accredited investors, but there's no solicitation allowed. And you have to verify that these are accredited investors. So you think you could have 35 unaccredited investors, but the lawyers tell you do not take any retail investors. 506C just changed it from no solicitation to solicitation allowed. And instead of investors being able to self-certify that they are accredited, you now had to have significant proof that they were accredited. It put the burden on the investors to prove that they're accredited, which is a sticky situation because nobody wants to share their tax returns, their investment statements with an entrepreneur. They just want to make an investment. Luckily, we've got these third-party technology companies that have come into the realm and allow investors to actually submit their information to that system, can verify it, and then you can get a letter of accreditation. But that's the 506C side now that allows accredited investors to invest in these offerings, same way they were doing in a 506B before.
I see. But you couldn't have a 506B offering at the same time as the Reg CF.
The only reason why that would be a challenge is because of the solicitation. When you're doing a Reg CF offering, it's purely general solicitation. Like you are putting it up on an online investment platform for anyone to see. The goal is exposure, awareness, getting the message out to as many people as possible. And a 506B is behind closed doors.
Right. Yeah. So you can actually solicit investors. You can put it on social media. You can shout it from the rooftops. That's completely fine with any offering through Reg CF, right?
Correct. Yep. There's no restrictions on what you can do. The only restriction is you can shout, you can say, I'm raising money, but you also have to say, I'm raising money on this platform. This is where you get your information. It's a very circumspect way in which you get that information to investors, because what we want through the law that we created is investors to have the same information. So the reason that we do this on online investment platforms, the reason we have you fill out a Form C, the reason that you've got a similar set of disclosures throughout the whole thing is we want investors to have the same access, the same information, so they can all decide whether or not it's right for them. So we don't want people to have different information. So that's the goal. Is we'll give you the ability to shout, but you have to tell people where to get that information.
Yeah, I always love that. I love that the questions even can't be outside of the platform. So that, therefore, if I'm an investor and maybe I didn't think of that question, but somebody else did, and they ask it and the founder answers it, I can see, oh, hey, that was a good question. And I got to see the answer all in the same place.
Oh my gosh, you hit on a point that I love about investment crowdfunding. So that comment section that's on these offering pages that you see online is where you should be focusing your attention. Because yeah, you've got access to all this information, but why don't you shortcut it and take a look at the questions and answers? There's a lot to be learned. You've got really sophisticated investors that are looking at these deals, questioning the technology, questioning the IP, questioning the team's experience. They have to justify this with answers. If they don't answer the questions, I know we have our own venture fund and we look at the deals and we're like, they're not answering the questions now. Why would they answer them later on? Pass. You don't want to do that. You really want to be upfront and out there with your answers, and you want to answer them as detailed as possible. We've also asked questions when we do our own diligence. We ask questions on these deals and we post them. And then if the entrepreneurs don't answer those questions, you will see, we were just looking at this yesterday, other people saying, why didn't you answer the question from Woodie that he asked about from the venture fund about your offering? If you don't build credibility with your investors, you're not going to raise the capital.
Yeah. So tell us a little bit about CCA and the annual report that you put out, which is very comprehensive.
Right. The annual report that we put out is like our brains, this entire state of the industry of investment crowdfunding. Okay, so CCA was built out of the meeting that we had at the White House. So President Obama signed the bill. We incorporated Crowdfund Capital Advisors, and we worked with governments and regulators around the world to create policy to enable investment crowdfunding. That also was the basis for which we started our database. I was on Bloomberg Television once we left the White House, and they said, you've got this fascinating background where you started on Wall Street, then you went to work for a database company in Silicon Valley. You started your own healthcare technology company so you can see what success looks like in these startups. And why don't you build a database that collects information on all these startups? And that's what I did. And that's the basis for our algorithm. It's the basis for everything that goes on within our research and analysis of this industry. And that's the annual report. Like when we first wrote our first annual report, it was 8 pages long.
Oh my.
This one is 210 pages long. It's got nearly 100 charts, graphs, images. If you want to know what is happening in this industry from an investor point of view, from an entrepreneur point of view, from an industry perspective, because this is not just investment crowdfunding as an industry, but healthcare, software. We have 30 different industry buckets. It's amazing to see how this is happening not only across 2,000 cities in the United States, but in every single industry that you can think of. When this started, I was like, all right, health, Main Street type businesses, debt crowdfunding, software businesses, equity crowdfunding. It's just where my brain was. And when I see all these healthcare or these clean tech, it's amazing what we're looking at. We just looked at that new Twitter competitor yesterday through our venture fund and the algorithm. It's the entire spectrum of offerings. You could have a Main Street barbershop that's raising capital. The future unicorns, I am a firm believer, are getting their funding inside investment crowdfunding. They're proving to their fans, their customers, that they can achieve something with the capital that they're getting from them. Then they're graduating from crowdfunding. Crowdfunding's not meant to be one all be all. It's meant to be your starting ground. I think from crowdfunding, you move to angels, you move to venture, or you engage angels and VCs in these deals, and you show the angels and VCs how you can be mature with capital, how you can hit milestones, and because you're mature and hit milestones, why you need bigger checks. And then we move them out of crowdfunding to VC, angel VC, Reg A offerings. And that's the projection that we're working from within this industry. The goal when we started this, and I talk about it all the time, was solving for the valley of death. And you've probably heard of this before. Everyone always talked about people can fund their own businesses with up to $25,000 of their own savings or their credit cards or their home equity line of credit. But after that, there's a gap between that and $250,000, which is what most companies need. And if there's no one funding in that, where are they going to get it? And this is where investment crowdfunding really filled that void. And it solves for that problem. Like the average raises now are about $800,000. So they're raising a lot more money. Now, that's not the same for debt-based crowdfunding. I want to say they're raising about $100,000, but they don't need as much. They need retail businesses. So the report itself covers all of that.
I love it. And so what are the industries that tend to do really well in this area?
Software and technology was having a great time. Literally, it's fascinating to watch people leave Google, people leave Apple, people leave Facebook, and start businesses that those companies wouldn't start within them. And they're getting their seeds and their funding through investment crowdfunding. But there was a shift in 2024 that I didn't even see coming. And that was healthcare, life sciences, biotechnology. So I think they were the ones that took the biggest brunt over the past 12, 24 months in terms of funding. But these ideas don't go away. There's still brilliant doctors and scientists that are working on creative solutions, and they're now coming online and they're raising capital through investment crowdfunding. So while software and technology was leading, I would say up to 2023, it fell off in 2024, and healthcare, life sciences, and biotechnology went to the top of the list in terms of the number of offerings, in terms of capital that was raised by them too. So it was fascinating in the industry side of that.
That is fascinating because these are usually companies that need a lot of money. Right?
Absolutely.
Yeah. So are they going out and finding the people that are affected by whatever the potential, it could be like a treatment or a cure for a disease or something like that are affected by it, and they're the ones who are investing? Or how are they going about finding the people to invest?
I feel like with the healthcare offerings and the CEOs that we've met and talked to through our venture fund, where we've invested in select ones, they are putting their offerings out there, going to their community of fellow doctors or scientists and saying, this is what I'm working on, engaging them as investors, validators, by the way, for what they're doing too, because in many cases, these doctors understand the problem. They're like, yeah, this is a problem I see on a daily basis. I'm glad you're working on the solution. So they become investors on their cap table, and then they get the company. The goal is not to get you through FDA approval. Like that, you're right. That takes tens of millions of dollars or many millions of dollars. But this is to prove that the concept is there, maybe get you through phase 1, get you up and running so that you can then go to some of these venture capital firms that are really focused on clinical trials or getting companies through the FDA approval process and being like, this is what we were able to do with our friends and family, our community. Now we actually need your help, your capital to get us to that stage. The best part about this though is that, and you and I both know this, most of these companies will fail or go under. The number one cause I will put out there is lack of capital. It's not because it's a bad idea. Sometimes it is a bad idea or their inability to execute, but it's really the inability to get the capital to take it to the next level. But the people that do get in there on the earliest level are getting it in on the lowest valuation. And some of those companies will make it through these hoops and they will get to the VC funding and they will get to that FDA approval. And when they get to that FDA, as they get closer and closer, the valuation of these companies doesn't go from 5 million to 7 million. It's going from 5 million to 20 million because we hit a pretty sizable milestone. And then it's going from 20 million to 60 million because we know that we're in clinical trials with this. And we now have other people that are saying, you know what, I might be interested in licensing this product. And so they get these letters of intent. And then, of course, when you've got something that's going to be going to market, these companies have $500 million valuations. The goal is figure out which of these companies you can invest in or invest in a select range of them. And that way you de-risk your investments by not investing everything in one basket or one egg. And your chances of making out are even better.
Yeah. I love that because I talk about it in my book, Do Good While Doing. I wrote a workbook, and one of the exercises in the workbook is to go find an equity crowdfunding site and make a mock portfolio just so that you can learn and see what's out there. And then if you want to go ahead and start investing, then at least now you have a pretty good idea of a couple of companies that you've looked at already. So I love that idea. As we're talking about this and we're talking about customers who become investors and investors who become customers, I know you've recently written a book called Investimers, which is such a great title. So good. So good. Yeah.
It's nearly 400 pages.
Oh my gosh, 400 pages.
Everything that's in my brain on investment crowdfunding and puts it into a book. The number one reason why I wanted to do this is there's a lot of people who say that they were responsible for this. And I will tell you first and foremost, this wouldn't have happened if it weren't for a large group of people pushing at the same time. I didn't know any of those people when I was walking the halls of Congress. I didn't know any of those people when I was testifying in front of the House and Senate. I met some of those people when I was at the White House saying, oh, I didn't know you were working on this. But I wanted for my children to know, for posterity purposes, the role that we played in helping launch this industry. And then the second part of it was there's so many different aspects of investment crowdfunding, and it all depends on the lens through which you're looking at it. Investors want to know, how do I make a smart investment decision into an investment crowdfunding company? So we covered that in the book. Policymakers want to know, what are the economic benefits of investment crowdfunding? Is this really good for our country or countries globally? And in the work that we did with the World Bank and the report that we wrote for the World Bank, we covered a lot of that. So I wanted to put that in the book as well, because this is about job creation. This is about innovation. When you have innovation, the amount of economic stimulus that you can have, not only for our GDP, but in local communities. Remember, this is not happening in New York or LA or Boston. This is happening in Denver, where I live. This is happening in smaller cities all across the United States. When these companies are successful, they're building big businesses in these local communities, and that has a massive impact. I wanted to talk about to entrepreneurs. I was just like, listen, with our data set, because we've been collecting all this, we now see all the signals of success. And so I pushed in a way that has never been pushed before. And even my finance professor that I ran this by said, Woody, you can't do that. And I said, that's what I wanted to hear. And I created a formula, which I call the crowdfundonomics formula, that looks at all the different variables that go into a crowdfunding offering. And I show you on a scale of 1 to 10 or 1 to 20, how you can break those down and what a 1 looks like and what a 20 looks like, and how you should aim for a 20. And as long as you're aiming for the highest amount within each of the variables, your outcome will be better. And we look at it from that point of view. But the book is, and I end with, where are we going with this? Everyone's talking about the future. I mean, talking about the present. I want to talk about the future. I was just like, listen, if there's one thing I know, blockchain is coming. We saw what happened with the STOs, the security token offerings, the ICOs, and how those blew up. Okay. But now we have a way to attach a regulated pathway. Investment crowdfunding, I believe, is one of those ways. And they've mentioned it in SEC updates, if you've been paying attention, for people to use investment crowdfunding as a framework for doing these security token offerings that are coming. And so in the book, I talk about how I believe that is the future, how the metaverse, I think, will play into this, how smart contracts will help us with the signing and all these deals happening. Transfer agents are going to be out of the picture because it's all going to be happening on the blockchain. So I dig into that. And then we live in this world, you and I are doing it right now, podcasting, social media, communication with each other in a small scale. One of the things that I talk about, and I coined this term, I have investors and then I've got influvestors, which are influencers that are investors, because you're going to see more people on social media going, hey guys, I'm like a customer of this business. They're doing a round of financing online. I just invested in them because they do X, Y, and Z great. And they're going to be now driving more awareness, more investors, sales to these companies. And so I'm painting the picture in the book of where the future of this industry is going.
Yeah. So right now, I think 2024, that was about 500, a little over 550 million. And so where do you think this is going to go over the next year, then 5 years, 10 years?
I was very optimistic about how things were going to go after the election. And then I've been very cautious about where I think things are happening now. And whether or not people want to, it's not whether or not tariffs or policy is going to make changes, it's how people believe things will play out. Because investments are made based, this is my own personal bias, by the way. I believe investments are based on sentiment, belief in a company, belief in an industry, belief in how the markets are moving or might be moving.
So Woody, in the past, sometimes crowdfunding was looked at with that ick factor. Like, you're really going to raise money this way. There's going to be so many investors and they're going to clutter up the cap table and all of these kind of negative things. So what do you think the sentiment is nowadays?
I think it's changed. If you look to what happened in the UK when the industry launched there, they were the initial group of people that had venture capital and angels getting in on these deals. They saw the benefit of having the crowd as a marketing brand advocacy group for a company, and they got right behind it. It took us a few years to get there, but now you're seeing Andreessen, you're seeing a lot of big VCs that are playing the space that get the fact that there's things that they can't do with their Rolodex. They can pour a ton of money into a company, but we've also seen how that doesn't also equate to success. Virality, brand advocacy, having an engaged group of investors works. And so we're seeing more VCs understanding that and the role of the crowd. And we've solved these problems, like the cap table problem has been solved. We've created SPVs that allow you to group the retail investors into one voting block. Okay, so now you just go to that SPV, they vote, and you get that done. So it streamlined a lot of what the problems that were there before. And I think we're just going to be seeing more of this. I also know, because I also speak with a lot of VCs, they're telling people, you know what, I love the idea. I love what you're working on. Go raise a round online. And you know why they're doing it? Because they want to see, A, can this entrepreneur raise capital from other people? B, can they hit milestones that they say they're going to hit with the capital that they raise? And C, do they communicate well with their investors once they raise this money? If you're doing all three of those things and you go back to the VCs after you've done it, they're ready to write checks. And I think this is a new way for them not only to de-risk their investments, but to allow these companies, to allow them to say, go somewhere else, do a bit of the work and come back and show me what you've done. Because a lot of times venture capital is making investments in a void where like, you're a really smart team. Like, I love the technology that you've built. I know you've worked for a company where you've done great things in the past, but can you do it on your own? This is now their card to be able to say, I just want to see what you can do and then come back to me. And so 5 years from now, you're going to be seeing a lot more venture and angels in these deals by default.
Yeah, I agree. I think it's one of those things, like, it was new. People didn't really understand it. They didn't know enough about it. They hadn't seen it play out all the way through in a company that had to raise multiple rounds of funding. So I get it. There was apprehension. But I do think it's a great way for investors to get started who have never done this before. And they are very nervous about, is this risky, or I don't really understand it. I don't think I'm smart enough. I need to have a finance degree. All of those things are not true. Of course, they're smart enough. Of course, they can make decisions. But I just like the idea that they can learn and not necessarily have to put a lot of money up front just in order to do that. I feel like that was one of the mistakes I made. I wanted to learn, so I got involved in deals that I had to write bigger checks than $100. I definitely love all of that. And I love the market validation that the entrepreneur can get by raising around like that.
And if they're really smart, they're using the crowd. They're like, listen, you guys have experience that I don't have. And so once they raise the money, and I get these emails from these select, not all of them, I wish more of these entrepreneurs would do it, but they would be like, listen, does anyone have just-in-time inventory experience? That was one of the queries that I got. And I was like, I actually do. And kudos to you for asking all of us that are investors rather than trying to find someone outside. And so I had one of these calls that went over how we did just-in-time inventory at FlavorX. It was incredibly beneficial. You're not just looking at the crowd for capital. You're looking at them for what knowledge they have. And I think the smart entrepreneurs that are raising money through this are leveraging the crowd that way to help them scale their businesses in ways that they can't do on their own.
Yeah, I love it. Okay, Woody, where can people get the report, the annual report first? And then we got to know how we're going to be able to all get the book.
If you just go to crowdfundcapitaladvisors.com, right up top, there's an area to get the annual report. There might even be a pop-up. I can actually make sure that's there. And it's free. We had a really nice backer that paid for everything this year, so nobody else had to pay. Normally, people were paying $2,500 for this report in the past. So take that as a validation point for why you should be reading this. So go there. And then Investimers is available on Amazon, Barnes & Noble, in a soft cover and a hardback. So
excellent. We will put all of those links in the show notes so that people can make sure that they get them. I know I downloaded the report from your website, and I think it is super fascinating to just see all of the things that are happening in this incredible space. And so much with debt crowdfunding, revenue-based financing crowdfunding, all of the things. So I'm excited to see what's going to happen in the future. But Woody, thank you so much for joining us today. Appreciate it.
Thank you. It was great to be here.
Thanks for listening. To connect with me, visit my website at marciadawood.com. And please subscribe, follow, and leave a review. It helps the podcast get seen by more people. And remember, you can also find the Angel Next Door podcast on YouTube too. And if you're looking to learn more about investing in the changes you want to see in the world, sign up for Ann and Bill Payne's ACA Angel University classes. Go to theangelcapitalassociation.org, all one word, to find out the schedule. And classes are now available on demand. Many classes are offered, everything from angel investing basics, which include fundamentals, risk, due diligence, term sheets, valuations, returns and portfolio strategy, and even a class on group formation. There's even a deeper dive where you can get advanced classes, including capitalization tables, startup boards, and exit strategies. If you're not already a member of the Angel Capital Association, you can become one for a low price that will give you unparalleled access to discounts, free webinars with a huge archive of content, networking opportunities, and much more. We'd love to have you join us. All content for this website is informational and not intended to serve as legal, tax, accounting, or investing advice. While Marcia, that's me, does serve on the SEC Small Business Capital Formation Advisory Committee, my views are my own and not the views of the SEC or my fellow colleagues on the committee. Our speakers and hosts are thoughtfully selected for their educational value, but their opinions are their own and do not necessarily represent the views of the host, me, or the Angel Capital Association, and neither specifically endorse the use of presenters' products or services. Listeners of the podcast should consult their own tax, investing, legal, or accounting advisors before making important financial decisions. All warranties, including accuracy, completeness, and suitability for specific purpose, are disclaimed.